Global asset pricing assumes ships can cross the ocean without interruption. When that physical certainty disappears, the mathematical models governing portfolios stop working. This dashboard tracks the market panic of April 2026. The VIX hit a danger level of 27. WTI crude oil climbed to $111 a barrel. Simultaneously, the U.S. 10-year Treasury yield reached 4.36%. Geopolitical escalation usually triggers a flight to safety, but spot gold fell 2.8% during this spike. Investors sold the ultimate safe haven at the exact moment the threat of war reached its peak. This price action indicates a structural shift. Institutional models are now pricing in the specific risks of secondary inflation and the physical bottlenecks of global supply chains. To understand the logic behind this sell-off, we have to trace the shockwave from its origin. We will follow the data from global interest rates down to the microscopic hardware engineering of the AI supercycle. Institutional capital has become hostage to the rigid limits of physical infrastructure. The value of an asset is no longer determined by software projections, but by the raw physics of its supply chain. The primary catalyst is the Strait of Hormuz. The threat of a total blockade places 20% of the world's daily oil supply at risk of an immediate cutoff. Oil at $111 a barrel acts as a direct tax on manufacturing economies. This energy shock pushed the U.S. trade deficit to $57.3 billion in February, as the cost of raw imports outpaced domestic production. This imported inflation restricts the Federal Reserve's options. The probability of a 2026 interest rate cut dropped to 12%, as consumer price risks became too high to ignore. This chart explains why gold failed. When nominal interest rates rise faster than inflation, real yields spike. A surging U.S. dollar and high real yields increase the opportunity cost of holding gold, leading to aggressive liquidations. High discount rates reduce the current value of future tech earnings. Capital is exiting long-duration software stocks and rotating into sectors with immediate physical utility: defense and energy. Energy and defense companies offer protection against inflation. They maintain high free cash flow while operating with low capital requirements or under the security of multi-year sovereign government contracts. In a stagflationary environment, the market awards its highest premium to assets backed by physical commodity pricing or guaranteed government spending. The macro shockwave also hit a specific industrial node, the Ras Laffan facility in Qatar. A localized strike forced the complex to suspend all operations. This facility accounts for 34% of the global supply of ultra-pure helium, a gas that must be exported through the now contested Strait of Hormuz. Modern semiconductor fabrication requires helium as a carrier gas for EUV lithography. Its unique thermal conductivity and chemical inertia make it physically irreplaceable for cooling wafers and maintaining plasma stability during the etching process. South Korean memory chip manufacturers Samsung and SK Hynix rely on Qatar for 65%. Pricing leverage has shifted from the chip designers to the domestic specialty gas producers who control the raw materials. This physical reality is causing a split within the technology sector. While software developers saw their valuations fall, AI hardware infrastructure providers surged by 15% during the same period. This chart compares a standard 10-kilowatt server rack to the requirements of next-generation AI. As the focus shifts from training to inference, power density is reaching 370 kilowatts per rack. At this density, traditional air cooling is physically incapable of removing heat fast enough to prevent GPUs from melting. Thermodynamics has become a hard limit on AI performance. Liquid cooling is now the mandatory engineering solution for the AI supercycle. Thermal management has become the primary physical constraint on the industry's growth. High thermal density also degrades electrical signals in copper wiring. To solve this, the industry is pivoting to co-packaged optics, using light to transmit data without the heat-induced signal loss of traditional metal cables. AI's expansion is no longer limited by GPU availability. The growth of the sector is now dictated by the physics of power transmission and heat dissipation. These terrestrial limits explain SpaceX's $1.75 trillion IPO valuation. The company generates $8 billion in annual profit and supports 10 million Starlink users. The high valuation is driven by a confidential filing to merge SpaceX with xAI, a company valued at $250 billion. This merger aims to solve the thermal and power bottlenecks mentioned earlier by moving compute nodes into space. An orbital data center would operate in the vacuum of low Earth orbit. Moving AI inference nodes to space allows the hardware to bypass the power constraints of terrestrial municipal grids. The thermal engineering advantage is clear. Space provides massive, unfiltered solar energy for power and an ambient temperature near absolute zero. This environment solves the cooling problems that are currently stalling data centers on Earth. The highest valuations in the next tech cycle belong to the companies that can escape the physical infrastructure limits of the planet. Investors face an immediate tactical challenge. Markets are entering a holiday period, just as critical U.S. employment data is released during a time of extreme geopolitical tension. This chart shows the resilience of the offshore RMB. Despite a surging U.S. dollar index, the CNH is holding steady at 6.88. This persists even as the U.S.-China yield spread reaches negative 2.5%. Markets are paying a premium for China's energy independence and manufacturing base. To protect a portfolio, capital must anchor to yield. High-dividend resource stocks provide a hedge against the secondary inflation imported through rising energy costs. Second, investors must rotate into military and aerospace supply chains to capture the long-term increase in sovereign defense spending. Finally, target the choke points. This means moving away from hardware assemblers exposed to memory inflation and into domestic liquid cooling and specialty gas monopolies. Surviving a stagflationary shock requires a shift in strategy. Capital must move away from abstract growth multiples and anchor itself to the hard realities of energy, defense, and physical engineering.